Hey, Dustin Tibbetts here, financial advisor with JazzWealth Managers. Welcome to FintTips, a really short series we do on our channel here to just cover something really simple, teach you something new, help you in some way with your retirement, your personal finances, and then get out of the way. We're JazzWealth Managers, financial advisors, and I hope you'll check us out at jazzwealth.com. We work with all investors. Doesn't matter how much or how little you have to get started with. Of course, we work with you either way, give you the same help that the wealthy get, of course, for everybody, so we can get you to the wealthy stage if you're not already there. Well, today I want to give you 4 discounted dividend stocks. And by no means am I recommending that you go out and buy these stocks today or anytime soon or should have already bought them. These are just ideas, right? Suggestions, and I want to give you sort of an in-depth look at how this thing goes. What you should know is at the moment, 38% of all the stocks in our dividend fund on our website are within 10% of hitting all-time highs. The stock market can't say the same. For the S&P 500, 34% of the stocks are within 10% of hitting their all-time highs. Our dividend fund is currently yielding 3.62%, whereas the S&P is only yielding 2.07%. And so there's a little bit of a, you can see like I'm trying to brag a little bit, right? Now, as of this taping, if you look back from now through the end to this time last year, let's go back 12 months. Let's take a look. The S&P 500 has actually gained just about 3%. Our dividend fund has also gained just about 3%. However, we got a slightly better yield, right? So total return's a little bit better. So all in all, dividend stocks, if you package them correctly, if you work with them correctly, they might offer less volatility, but good total return, right? Dividend stocks are great so long as you pick stocks that consistently pay the dividends, are paying maybe towards the higher end of what they normally pay for dividends, and have enough money to pay the dividends, right? Don't fall for that where you buy a stock that shows a really high dividend, but they've yet to figure out how they're going to pay it, or they're going to use some trickery in finance to pay your dividend. You want guys that have a lot of money already and have a history of paying those dividends if you can. Again, I'm not making the suggestion that you buy these stocks. I'm just pointing them out. If you like discounted stocks, maybe you like a few of these, maybe you don't. Feel free to agree or disagree. All right, the first one we're going to take a look at is Qualcomm. These guys are fighting it out with Apple right now, and I think they're winning, to be honest with you. They're sort of winning the battle. But anyways, you can see the stock price on there. Here's the daily chart going all the way back here to last August. You could see it has not participated in the market's most recent rally. The stock is currently paying a 4.67% dividend. Here's how this works, by the way. The company at the end of the year, all things remaining equal, will pay a total dividend of $2.48, which you would get, right? They have $8.50 per share that's out there in cash. So they have more than enough cash to invest, do all kinds of stuff, sue Apple a little bit more, and still pay the dividend. So not only is the stock discounted, you could see it's rather weak at the moment. It's actually just off what technical traders would call weekly support if you were to look at a weekly time period. It's bounced just off of that a little bit, but they have more than enough money to pay that dividend. Okay, moving on. The symbol is ABBV. The stock is AbbVie. Now, these guys are in the drug manufacturing space. These guys are paying 5.35% as far as a dividend yield. Now, that's high for them. This is towards the upper end of the range that they normally would pay, if not the high for them. They have plenty of cash to pay, just like Qualcomm. And you can see recently a lot of what we would call relative weakness, meaning the markets have been strong, AbbVie has been weak, right? Now, if you look further, I can't zoom out at the moment, but if you look further on a weekly time period, you can see a lot of weekly support right around the low 70s there. So there's a chance you may even be able to get more of a discount if this thing gets weaker. Again, I'm not suggesting that it will go there. I'm not saying to buy it if it goes there. I'm just saying there's a chance you get an even further discount on this stock here. So there you go. Just wanted to point that one out there for you as well. CVS, here's a name we've all heard of. CVS is the sort of drug pharmacy, expensive candy store on every corner out there. And these guys are paying 3.23%. This is the lowest of all of the ones I'm suggesting today. They're expanding their WellCare clinics. They're having a little bit of a tough time now with the long-term care side of things. They'll work it out. Everything will be fine, in my opinion. But during this expansion, it's kind of a bad time for them to experience a little bit of a problem. But they have way more cash than they need to pay this dividend, so you're in good shape there, and the stock is naturally discounted. You can see trading at the lowest end of its range over the last year. So if you like to buy discounted stocks, there you go, there's another one. Well, if you like discounted stocks, you're gonna love this one. This one's Kraft Heinz, right? Oscar Mayer Wiener, Heinz ketchup, you get the idea here. This stock, if you like discounts, this would fall into the falling knife category. Stock's down over 50% for the year, 28% of it coming in just the last trading day. For Kraft Heinz, it's been rough for them. They're seeing a big downtick in their sales. They've sort of charged off some of their lower, some of their products that don't, not really keeping up there anymore. Just a lot of bad news for them right now, naturally, and so the stock is lower. I am definitely not suggesting that now is the time to buy the stock. I just want to point out they pay 7.15% as far as a dividend goes. That is also at the very high end of the range for them. It probably should be, right? It falls into the consumer staples-ish category. So if you like that sector, if you think it's a little bit defensive, and you go, okay, well, here's a discounted stock that's a little defensive in a way. Consumer staples, people will buy this stuff in any economy. Well, hopefully. Yeah, I don't have a lot of good stuff to say about this one, but you got a big discount here. You got a 50% discount and a 7.15% dividend yield. I don't know if that's interesting to you. I don't know if any of these stocks are interesting to you, but I like to point these things out when I can. Let me know what you think. Are you a falling knife investor? Does Kraft seem like, holy cow, that's a great deal, I'll buy a discounted stock? Or does that scare you? You go, that's ridiculous, I'm not going to buy that stock. And what about the other ones? Do you like the idea of building a dividend portfolio of stocks that can actually pay, right? So a lot of the names that we talked about today, those are in our dividend fund portfolio. You know how it performs. You can also go on our website and check out the history of those funds if you're interested, along with all the other ones. But that's all I have for you today. So enjoy. I hope you enjoyed, and we'll talk to you soon. Thanks.
Why should you choose JazzWealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.